April's generally a strong month for the markets. And then historically, if we see the major indices up in Q1 following a down year, the same setup we have right now, we again historically see quarters 2 to 4 in the green. In this case, with so much disruption from banks, rate hikes, et cetera, do you see history repeating itself?
You know, I don't. And obviously, that's a technical, part of the market. When we look at the fundamentals, there's just a lot of negativity here in the soup of this market. So this banking crisis is something we really need to focus on. I know it seems stabilized right now, and our hope is that it does remain stabilized. But we see this as just kind of the first leg of kind of the dislocation in the markets. The problems that we're seeing in the banking sector aren't just going to go away. And I think there's not enough focus on the lending that's going on to banks, where they're able to borrow at par against the securities within their portfolio. The rate on that is 5%. And so if you look at the securities they're lending against or borrowing against, the rates on those are much lower. So this effectively is going to lead towards more zombie banks. As the term is picking up steam here. Really, we're talking about banks that just profitability will be muted for the foreseeable future. Okay. So that's the first, step we see towards this economy starting. Yeah.
So, Adam, I want to hit on a word that you just hit on, stabilization. That was the reason why OPEC decided to do cuts. We're seeing the oil markets up more than 5% this morning. We are also just 30 days away from the next Fed rate decision. How do these two things, the oil output cut and the impact on prices, does it change your thesis, your portfolio management, your balancing at all?
It does add to the risk of what the Fed's going to do. We're heavily pushing our portfolios into fixed income. We're using a higher grade tilt within our portfolio. So, we're looking at treasuries, agencies, and the corporates that are, AA, AAA rated within our portfolios, and we're extending duration. And we're doing that because we think the Fed's really, their back is against the wall. And so we don't think that they will be able to continue to push rates higher that much this year. We do think there'll probably be another quarter basis point hike. But after that, we don't see really any way that the Fed can continue to increase interest rates. If anything, they're at a minimum going to be able to pause, but we think they might have to cut interest rates by the end of the year.
Okay, I know you're also watching the commercial real estate sector. Any concerns about contagion from what we're seeing in the commercial real estate sector hitting other areas of the market outside of real estate?
Yeah, I think the problem that we have in the commercial real estate market really is a liquidity issue. When we've got the rates on commercial real estate when you're borrowing in that sector is based off of LIBOR or SOFR. So unlike your traditional residential mortgage, these rates are actually going up as SOFR and LIBOR have gone towards 5% or above. So that's really stressing that part of the market. And if we continue to see stress in that part of the market, I think that we will start to see liquidity issues kind of percolate up through other parts, particularly private equity. Okay. That's another part of the market where the mark-to-market risk that we saw within some of these banks is prevalent there, and probably even more so. So if liquidity becomes even more crunched and those funds are forced to sell securities and realize those losses, I think that's where you'll start to see contagion throughout the rest of the market.